Well, Diwali is round the corner. Diwali is usually the occasion when everybody talks about their own portfolios. It's a celebration of wealth in many ways. People take stock of their portfolios, discuss what should the approach be from here on to manage their wealth, and of course seek blessings of Goddess Lakshmi. So today we thought of getting you a special conversation with our friend Saurabh Mukherjea joining us on the show. He's been associated for long as far as the coffee can investing approach is concerned. So today we are going to talk about that in detail to help our viewers become better investors. Saurabh, thank you very much for your time today chatting about management of wealth. That's the new avatar. You've become a professional money manager. So talk to us about the idea of coffee can investing approach and what exactly does it aim to help investors with?
So look, I mean, the approach goes back, I think 40, almost 50 years to a guy called Robert Kirby who worked for Capital, one of the world's largest fund management organizations. He worked for Capital in Los Angeles, and he hit upon this approach sometime in the mid-70s. He figured out that if you make good stock selection, if you choose good stocks, and you just let the portfolio be for very long periods of time, you make a great deal of money. By great deal of money, we're talking about 5x, 10x, 15x over a decade period. And in 1984, he wrote a paper, a 4-page paper called the coffee can investing approach, and that paper's formed the basis for I think some of the world's greatest money managers over the last 30-40 years. That's the crux of the approach: buy great companies and then let it be for 10-15 years. It'll make you very rich. It's made Rob Kirby a celebrity, and I'm hoping that it'll allow Indians also to make money.
Saurabh, you know, Indians are, especially a lot of people, the ecosystem we interact with, including your own circle, are usually have the do something syndrome because they are hit by information, some incremental news to act upon, and hence there's an urge to do something about it. Now that in your new avatar as a professional money manager, you're going and meeting investors and potential clients. When you drive this point home, is there acceptability? How are they reacting to this idea of less activity and sitting on for a long time?
It's not just Indians. I think people the world over, even myself, right? The instinct is to say, I've read an annual report, I've met a management team, let me do something about it, right? We are all creatures from the jungle, we are creatures of reflex, and hence to subdue the reflex instinct is very hard. And one of the reasons Rob Kirby's approach I think is so powerful is because it makes you subdue your instincts and trade less. Now, as soon as you trade less, you bring two powerful effects into play. Firstly, the transaction costs of brokerage is off the table. So even a well-run mutual fund portfolio in our country which earns by say 30% a year will by the end of the 10th year give away 12 to 15% of its corpus through brokerage costs, right? Second benefit of trading less is you avoid capital gains tax, right? If you're holding a stock for 10 years, you're paying the capital gains tax right at the end rather than paying it each year as you churn the portfolio. Between these two effects, you save at least 30% of the terminal value of your portfolio by trading less. So even before we get into stock selection and how good our stocks are, we're immediately saving money for ourselves, for our investors by trading less. And that's how you conquer your reflex. You tell yourself that trading is expensive, it'll cost me a lot of money in the long run, and I should therefore do less. It doesn't mean I sit back and do nothing. I still meet companies, research them threadbare, but the instinct is not to hit the trading terminal and bang out trades.
Saurabh, what to your mind is an ideal portfolio approach for investors here in India? There is a constant dilemma whether to go the mid-cap way because the returns look much more handsome there, or should you find safety in large caps which sometimes tend to become boring because they are slow compounders over a lot, or is there a balanced approach as well when we talk about coffee can investing approach by which best of both the worlds can be obtained?
So look, at one level, by using a straightforward filter, so say a filter which says I will buy companies whose revenues have grown at double digits over the past 10 years, and alongside that they've given a return on capital which is above say 12% post-tax ROC of 12%. By using that approach, you're taking this should I buy large cap, small cap, should I buy banks, FMCG off the table. You're simply saying whatever passes this filter, it's a sector agnostic filter, whatever passes that filter I'm buying it and I'm holding it for 10 years. So that's one way to simplify the approach. That being said, there's also another very influential school of thought, I would say, led by Howard Marks and articulated beautifully in Howard Marks's latest book, which is saying that it's all very well to have part of your portfolio, say half of your portfolio in structural plays, which have strong cross-cycle performance, but you can also think about timing the economic cycle. You might not be able to time it to the precise month or the quarter, but certainly the broad thrust of the economic cycle can be timed. So the other half of your portfolio should look to play the economic cycle. And therefore, for clients of ours who are also interested not just in structural plays, they also want to have some degree of economic cycle timing, we're creating a bifurcated portfolio. So half of it will be long-term compounders, structural plays, consistent compounders, and the other half of your portfolio will be plays on the economic cycle. So for instance, at the current juncture, my reckoning growth is coming down, interest rates are rising, the currency is weakening, and therefore in the other half of the portfolio, I'll play sectors which benefit from that. So you can say I will have a bifurcated portfolio, half in structural long-term compounders, consistent compounders, and half in timing the economic cycle. I'm still studying outstanding companies. I'm still taking a 2 to 3 year view, but I'm trying to play the economic cycle in the direction of, say, what Howard Marks is saying in his latest book.
Saurabh, also we are observing that in the economy, in our system, the creed of people who are taking equities seriously is only increasing.
Yeah.
The numbers of last couple of years, the way mutual fund AUMs have swelled is
Absolutely,
an example.
yeah.
A lot of peers of yours in the industry, including you, have taken the plunge of becoming individual professional investor now. What's the runway looking like right now for India, and how big is the size of the opportunity which some of perhaps us who are very close to the system are ignoring, and we should take it more seriously over the next 10-15 year period?
So look, I think the RBI published a superb piece of research around August 2017, and that said that, say, in neighborhoods like the one we are standing in suburban Mumbai, 95% of household wealth is in real estate, gold and consumer durables, right? So barely 5% of wealth in an affluent neighborhood like this is in financial assets, right? And that's not going to be sustainable, because that 95%, which is in physical assets, isn't really growing at any real rate. So as Indians in your and my social circle, as Indians, affluent Indians, head towards retirement over the next 10-20 years, they're saying we need to compound our money at a decent rate. And that's leading to this impetus into equities, which, as you said, the mutual funds have already benefited from. And what people like me are seeing, and which is why I think several of us are saying will become money managers, is numerous people from affluent backgrounds are coming to us and saying, can you please help me over the next 10-20 years get a good return on my portfolio, so that, say, at age 60 or 65, I can have a decent retirement. I think that impulse is so strong, Ajay. I reckon 10 years out, we'll be saving close to $1 trillion a year in financial savings. At the moment, we do around $200 billion a year in household financial savings. I think that number will grow 5x over the next 10 years.
So that clearly indicates what the size of our market capitalization of our country or size of overall GDP can grow.
So at the moment, the Indian market cap is $3 trillion. And I'm saying 10 years hence, every single year we will save $1 trillion a year.
My goodness. Okay. The other point let's talk about is, on the one hand, investors are open to taking help from professionals like you. At the same time, they want to take part of that portfolio and do or manage it themselves as well. Those who want to go out by themselves, how critical is mapping the state of the economy? Because there's constant debate that stock prices and the markets not necessarily move in tandem with the state of the economy or the economy cycle. Either they are ahead of it or they are behind. And how critical is to analyze which sectors will benefit or will decelerate more in that particular state of economy?
So look, I would say there are 3 phases to an investor's evolution, right? And if I take my own career, the first 10 years, I basically learned how to analyze financial statements, how to quiz company management teams, how to look for data from distributors, dealers, etc. So you basically train yourself to analyze companies over the first 10 years. The next 10 years, you train yourself to invest without trading, right? So investing means you train yourself to invest for the long run without hitting the buy sell button every 3-4 weeks. I think, and to be honest, that's the hardest phase, because you're learning and you're growing, but you're teaching yourself to act less instinctively, to act on without acting on response, so on reflex. So I think that's the sort of second phase, and I think most investors who are investing for themselves, I think would do well to be in that phase where you're buying great companies and you're letting them run for great periods of time. I think the third phase in an investor's evolution, which people like Marx and say Klarman and Baupost have obviously reached over the last 10-20 years, is over and above buying great companies, you also been able to figure out a broad way to figure out the economic cycle. I think Ray Dalio is another great investor who's figured this out. A broad set of metrics, parameters, which give you a guide as to where we are in the economic cycle, and therefore which sectoral bets you should ramp up and which you should ramp down on. I would suggest this third phase should only be tried by full-time professional investors or even retail investors who are doing trading full-time, because this is hard stuff and you are in the realms of trying to time sector, which is always tricky. But that second phase is the sweet spot, and I think a lot of your viewers sitting at home can do it themselves. They can buy great companies and grow rich as those companies compound by 100, 200, 300x over the next 20 years.
So let's talk about the portfolio construction
Sure.
approach. You know, some people believe that diversification is the key,
Yeah.
and 30, 40 good names in your portfolio
Yeah.
should be enough.
Yeah.
Others believe that no, concentration is the key.
Yeah.
You figure out 12, 15 good names and stick to it. What are the merits and demerits of both these approaches in your view, and also what would you choose when you are setting up your 3 strategies and at your own fund?
So look, modern portfolio theory that sort of all of us learnt in our formative years as investors, that says that 15 stocks gives you broadly the diversification you need. So beyond 15, if you're diversifying your portfolio, you're not doing it strictly from a diversification perspective, you've got other reasons for doing so. That being said, my reckoning increasingly is that you don't even need 15. Right? What you need is, say, a dozen really high quality names in your portfolio, and if you find, say, 14 or 15 top notch names, by all means let's have 15, but as long as you have dozen outstanding names in your portfolio, you're fine. And in that approach, I don't think I'm deviating too far away from Kirby's approach in his original coffee can paper in '84, where if an investor himself feels uneasy, if a client feels uneasy, we try to give them some comfort as we say that, look, for the first dozen of your stocks, we are buying you structural compounders. If you want some additional mental comfort, if you as an investor want some additional mental comfort, we can buy you a further buffer of 5 to 10 stocks, which allow you to capitalize on the current phase of the economic cycle, which, as I said, over the next couple of years, I think the economic cycle is going to decelerate. But from a purist perspective, if left to me, I would have a portfolio with 12 top quality names in it. I think that gives investors adequate diversification and gives them a focused ability to generate wealth over time.
Saurabh, how important is to adjust return expectations? Because our own analysis shows that for the last 25, 30 years, the benchmark indices in India have given 16, 17% annually. The longest performing mutual funds, assorted mutual funds in India, 4, 5 of them are there, have given at best 20 to 24%.
Yeah.
Whereas mid-cap centric portfolios in smaller period of time, 3 to 5 year period, sometimes give as high as 30%. And investor gets confused that which is the right way and how much expectation should one have as far as portfolios are concerned over 10, 15 year period in the economic cycle we are in right now in your view?
I think there's 2 challenges with this whole debate on returns. One is people tend to, as you just said, people tend to look back at the last 3, 4, 5 years and use that to benchmark returns, right? And that's typically the disaster which gets people sucked into real estate. People typically tend to say last 3, 4 years how much is real estate made, and they get pulled into a illiquid asset class which also has tax issues associated with it, right? So looking back 3, 4 years is I think a challenge in terms of getting a grip on returns, and my preference is to look at 10 to 20 year data runs. If you look at 10 to 20 year data runs, the Sensex and the Nifty give around 15%, and I think that's a relatively sensible benchmark to take for the index. The second challenge with this return debate is very few people measure volatility. And if you don't measure volatility, if you don't have a grip on volatility, you get into an asset class, but if the asset class zigs and zags, right, which small cap equities does and mid cap equities does, then that volatility will burn you, right? You will not be able to emotionally deal with the volatility. So therefore, the other thing we are very keen to focus on is not only get decent returns, say in the mid-20s, we are very keen to dampen the volatility, because if you don't dampen the volatility, the client will run away. He simply doesn't have the appetite for a roller coaster ride. So the beauty about investing in top quality names and holding for 10 years is the volatility comes down to as little as a government bond, right? So you're not only getting mid-20s returns, but you're getting very low volatility, which makes it far more likely that the investor will stay for the ride rather than leave at the worst point in the cycle.
The debate is also on right now that India is becoming a larger economy every 3, 4, 5 years. How much alpha generation opportunities does Indian stock market offer? The kind of stocks which are listed, every bull run there are new representation coming in from newer sectors. Now that you're setting out on your own as a portfolio manager, what's your own analysis and research show about alpha generation opportunities in India next 10, 15 years?
So I think two parts to that answer, Ajay. Firstly, it's relatively clear looking at the data on large cap mutual fund. That data is publicly available. It's pretty clear that no more than say maximum 5% of our large cap mutual funds have any ability to deliver alpha outperformance over meaningful lengths of time. And the reason for that is pretty easy. 80% of the BSE 100 stocks, 80% of the BSE 100 liquidity is now in institutional hands, right? So it's very difficult for too many institutions to deliver alpha because they're trading with each other, right? And therefore, from that regard, to generate alpha, one has to go down the market cap spectrum a little bit. The second is from an Indian high net worth investor's perspective, I think it increasingly does make sense to diversify their portfolios on a pan-Asia basis. There's no reason to believe that only our country has great companies, right? There are well-run companies in markets like Thailand, in Singapore, in Malaysia, in Indonesia, in Philippines, and hence I think increasingly what Indian high net worth investors will do is build diversified portfolios across Asian equity markets using the LRS quota. So if you just buy large cap mutual funds, it will be very difficult to generate alpha because they are in an incredibly competitive space. Going towards small and mid cap, high quality small and mid cap stock picking makes sense, and building pan Asia portfolios makes sense.
Viewers are very keen, a lot of people we speak to are keen to understand whether national politics or state politics, which tend to get a lot of share of mind share in the market. Sure. How much does it really impact portfolio returns over a longer period of time?
What's astonishing about Indian politics is even the on-the-day reaction of markets post the results coming out. Pre-results, exit polls have very little predictive value, as we know. But even the announced results seem to have very little predictive value, right? So whether we look at the 2004 results, the 2009 results, recent assembly election results, the post-results market move also tells you very little. So I have to concede, and I think there's plenty of proof that political outcomes have zilch effect on investor portfolios. The core driver of your wealth will be high quality stock selection and patience, the combination of stock selection and patience.
Quarterly earnings for that matter, because we have observed that over a 20 quarter basis, there are 4-5 bad quarters for a company, but interestingly the lowest prices of the stock price are also available in those 4 bad quarters, which most people shun, and by that time the stock is already high. So how much important is quarterly earnings over a long period of holding of a good stock in a portfolio?
So I think let me make I think it's a quite sort of interesting point. On the one hand, we can't ignore quarterly earnings. On the other hand, as you said, it has very little predictive value. So what people like me tend to do is, so for example, basis the funding crunch in NBFCs, we had a good sense that Maruti's results will be subpar, right? And we also knew that auto ancillary stocks would correct. So there were a couple of auto ancillary stocks that we had an eye on, and we wanted to buy them cheap. So we told our broker that post the Maruti results, these stocks will come off 5-10%, and if they come off 5-10%, buy them at the 1-year low, right? So we were interested in the results, not so much to say, well, can we time our entry into Maruti? We can't, but we were interested in it because we had a sense that it would allow us to buy something else at a bargain basement price. So using quarterly results to make, to time a specific stock, I think is tough. But you can't ignore it because there is liquidity on results days, and one tries to use that constructively.
Okay, my last question to you is regarding your interaction with Indian managements. You've been doing it for a very long time and have written a very wonderful book which I read, Unusual Billionaires. When you interact with companies which are growing in size right now, may not be very large companies right now, across sectors, what is the sense you are getting about how the corporate India could pan in this 10-15 year period? Because availability of a lot of flows from investable surpluses of affluent people is one thing, but does the market have depth, or do you see in the next 10 years enough big entrepreneurs coming out with interesting companies, making them large, will we be able to suck that money or absorb that money?
So I think there are two different trends, Ajay. I think the trend one is that if I look say at roughly the 1,000 stocks below the BSE 500, I would say no more than say 30 to 40 have good capital allocation. A focused management team which is saying that I understand the potential in my sector. I'm going to patiently build a great franchise. So I would say, no more than 3% of the small cap population, 3% of the small cap population has this ability to become an unusual billionaire, become a long-term structural compounder. But the good news is there are 30 to 40 such companies who are doing a very good job. A further challenge for this 30 to 40 is succession planning, because in a lot of instances, the next generation doesn't seem to be interested in running the business. They would rather migrate abroad or sell it off and become say a .com or become a venture capitalist. And I think that's why the population of high quality compounders and small caps that you can invest in is actually no more than 20-25, because in many instances I'm seeing the second generation doesn't want to go to the factory every day, walk the shop floor, improve efficiency, improve the working capital cycle. They're saying it's too much work. We would rather be sitting in New York in a 50-story high rise, trading for a Wall Street investment bank. And I think that does make succession planning a fairly dicey affair for a lot of successful small cap companies.
On that interesting note, Saurabh, I'll let you go. Thank you so much.
Thanks, thank you for your time.
Wish you a very happy Diwali at your entire team from ET Now. You've been a great contributor on the channel and always enjoy having chats with you.
Happy Diwali to you and your colleagues as well.
Thank you very much.
Thanks.
With that, it's back.